Welcome to our outlook for 2018. After an exuberant year in the markets in 2017, just how much higher can they go? Growth momentum looks strong, synchronized, and ready to extend further. Yet, market valuations are feeling toppish, especially with central banks heading for the QE exits. Extra time was granted to the US expansion by the fiscal push signed into law in December, and US equities should hit the ground running early in 2018. Companies with relatively high tax rates and mainly US-based revenues should gain the most. We have a preference for domestically oriented names, but also banks and defense stocks. We also keep a slight overweight on US growth stocks, tech-heavy and better exposed to late-cycle performance. In Europe, we expect a fully fledged cyclical pickup in investment. Structures have aged, and brighter demand prospects mean corporations should want to exploit cheap financing to refresh their production capacity. In Japan, Prime Minister Abe's government is rumored to be preparing a fiscal reform package that will heavily incentivize companies to put their cash to work. Eurozone and Japanese stocks, which are enjoying the benefits of ongoing reflation, could outperform their US counterparts, provided that the euro and the yen do not firm up. Political hazards in the Eurozone in H1 and the BOJ rate anchoring policy should help with that. With regards to inflation, US wage pressures should start to increase due to labor shortages, prompting us to look for entry points into US break-evens early in Q1. However, we expect the overall inflation picture to remain contained, allowing major central banks to proceed with their slow normalization. We expect sovereign yields to drift higher this year and still prefer equities to sovereign bonds, which we rate at slight underweight. We also suggest protecting long US risk asset exposures with a slight underweight on US high-yield credit. We are, however, more constructive on European high-yielding papers and especially contingent convertible bonds. After a stellar year in 2017, the environment should be less supportive for emerging markets this year, as US monetary tightening advances and domestic growth pulses moderate. Although controlled, China's economy, the major driver for the region, still slows down. With selectivity key, we favor Korea, Brazil or Russia equity markets over the likes of Turkey. Commodity producers in particular will benefit from the oil prices recovery, which should stabilize going forward as the support of a weaker dollar fades and supply balances out demand. Thanks for having followed us today, and all the best for 2018.